Okay. What are you guys doing here? I made a video this morning. Did you watch it? You did? Alright, real good. You want to make money and get paid dividends? Oh, and you also want some safe stocks that will pay you to chill on the beach eventually? Okay. And you want the best of the best. Well, I gotta confess something to you. You're on the right YouTube channel, my friend. Let's get stupid rich. So here's what you can expect, you hungry investor. I'll cover 3 stocks, count them, raz, dva, three, that you can buy, hold, and get paid nicely for it. All I ask is you like the smash button. Let's jump into it. Some people like real estate. I'm the opposite. I don't want to own a house and be stuck in one spot in charge of property taxes, mortgage, and potential tenants. But there's a stock that caught my eye. Have you guys heard of REITs? It stands for Real Estate Investment Trust and is a company that owns, in most cases, operates income-producing real estate. REITs own many types of commercial real estate ranging from office and apartment buildings to warehouses, hospitals, shopping centers, and hotels. And the REIT that stood out to me is called Welltower, ticker symbol WELL. This REIT is focused on healthcare properties and mostly in the senior living space. And oh boy, I'm excited to dive in a little deeper for you guys, so let's discuss their business and why they will benefit and grow as a company, and the juicy dividend is just so sweet. Business. From their website, Welltower delivers the healthcare infrastructure necessary to facilitate better treatment at lower costs and keep patients out of the hospital. They provide real estate capital to senior housing operators, post-acute care providers, and health systems. Basically, through their capital, these companies are able to grow, innovate, and ultimately provide better care with the money. Welltower isn't just a landlord like many REITs. Instead, the company aims to create and nurture lasting partnerships with some of the best operators in the senior housing, post-acute, and outpatient medical businesses. And that matters. The second thing is beneficial trends. So let's talk about the trend in senior living because the trend is your friend. Well, I'm your friend. Welltower should benefit from a long-tail demographic trend as the older groups of the American population gradually get much larger over the next few decades. Here's an image of the United States population pyramid. This chart visually shows you the amount of people in each category. As you can see, we have a peak at the 55 to 59 age category with much more people around those age ranges below and a little bit above. So it's safe to say there will be plenty of people needing assisted living and senior care in the future. So this stock is a forever hold in my opinion. Lastly, let's discuss the dividend because that's what I promised in this video. The current dividend yield is a whopping 4.43%. They pay 87 cents per quarter for each share that you own. And let's take a look at the dividend history to see how stable it is. Wow, look at that consistency. As you can see, all these years and quarters have been extremely consistent. This might be my retirement plan. I'll touch on one more thing since I've made a video on value stocks, which if you haven't checked out, you should really look at my last few videos to be ahead of what might happen. I'll put up a card right here. This stock goes well with that video because Welltower has a lot of the value characteristics that I look for. Taking a look at the PE ratio, it is well below the S&P 500, which is a very good sign for me. Overall, I give this stock an A+ for a strong dividend. Since 1971, the company has averaged annual returns of 16%, consistently outperforming the market, and has increased its dividend at a rate of 5.6% per year. Are you guys ready for the next winner? The next winner on my list is AT&T. The telecom giant AT&T has increased its dividend every year for almost 4 decades. Hold up! Every year? Yeah, I know. Can you say, dang son? Dang son? What's interesting about AT&T is that they receive utility-like steady income from their core wireless phone and high-speed internet customers. Because the business, which I probably don't have to introduce, has a monthly and yearly plans available for a service that is essential in our day and age, they have the safest cash flow. They have some interesting stuff with the streaming going on, so that could be a long tail growth factor for them, but that's besides the point for now. I'm looking at their dividend history, and this is another early retirement stock to own. That dividend is 7%. Come on guys, that's double Coca-Cola dividend, which is also a notable dividend stock. I personally would make this stock work for me even harder by selling a call to generate income on top of owning the stock. That way I collect extra income for basically doing nothing. I'm not going to go off topic, but if you want to know more about that, you can join my Patreon, and I will post that example today explaining more about that. But let's keep moving because I have to get to the third stock that is up over 20% year to date and has had 52 years of consecutive dividend raises, and that is Target. This is an interesting stock because I've been shopping there and I previously overlooked it, so this is a stock I really spent some time researching. You may be noticing a common theme here from Welltower and AT&T. Target sells products that people really need, and it has done an excellent job of growing its online sales. Sales in some of its departments, such as electronics, may suffer in recessions, but it is generally a very well-functioning business, even in tough times, which is why they have given investors 52 years of consecutive dividend raises. But I want to spend some time on online sales because I think this is an area Target is excelling at and even beating some of the competitors like Walmart and Amazon. So I'll discuss their business strengths and I will wrap up with their dividend history before I let you beautiful people click off of my video. Nobody does that, right? Right? Please tell me don't click off my videos. Target just posted 24.3% comparable sales in its second quarter, and adjusted earnings per share nearly doubled to $3.38. They seem to be coming out as a winner in this area of tough times compared to Amazon's North American e-commerce segment and Walmart's US business. Target, which only operates stores in the US, has a much wider operating margin. In fact, in the second quarter, Target posted an operating margin of 9.6%. By comparison, Walmart's US operating margin was just 5.5% in the quarter, while Amazon was even lower at 3.9%. Target, how are you nearly doubling your competitors? Is it because I shop there? Target, on the other hand, operates in 5 business segments: food and beverage, beauty and household essentials, hard lines such as electronics and toys, apparel and accessories, and home furnishing and decor, with sales roughly evenly divided among all of those 5 segments. Target's style categories like apparel and home tend to generate higher margins than groceries, which is kind of the secret, but the combination of those businesses gives it a unique strength. Groceries drive frequent visits and spur purchases for higher margin discretionary items in areas like apparel. So basically the people are going like, yo, let me get some of my coconut water, let me get some fruits. Wait, I need a new shirt. This strategy paid off in the second quarter as Target's apparel comparable sales rose by double digits, even as sales at clothing stores fell by 36% in that period, according to the Census Bureau. I will have an article link that I used for that information. So we know the business is rock solid. They pay a $2.72 dividend per year. Hey, that's my Central High School graduating class number. It comes in at just 1.8% dividend, but the thing is, it's grown 52 consecutive years in a row, and it's only on the lower end because the stock has gone up so much in the past year. Just take a look at the 1-year chart. So guys, this is a dividend king in my opinion. Don't be fooled that the dividend is less than 2% because the stock has a lot of growth factors. As one of my comments actually said in a recent video, and he's actually a genius on Wall Street. He's an options trader, and I worked with him, and he asked me, why am I recommending value stocks when I was just recommending growth stocks? And I had a very honest, transparent response. The truth is, you need both. Being all value stocks can make you fall behind in a fast-moving bull market, but being all growth stocks isn't a smart idea either. I don't do the BS all dividend growth portfolio because I'm more aggressive than that, but I also don't have all growth stocks because that's not a well-diversified portfolio either. So what I'm saying is you need both, and Target is that awesome mix of growth, value, and dividend. Got it, guys? Ask me any questions you guys like. I'm transparent on my YouTube channel and helping everyone is my priority and what I spend well over 40 hours a week doing, in addition to Patreon and talking with you guys and decide to book a call with me. If you want a free stock for just signing up, a legit free money, check out my link for Webull in my description. They give you a second stock when you deposit $100. They are essentially the same thing as Robinhood, and I have both apps. It also helps out the channel. Hope this video was super helpful. I did my best to be thorough and detailed because I love my YouTube family. Just remember, life doesn't have any guarantees, and I'm not a licensed professional. With great power comes great responsibility, and you guys have to know that. Thank you for liking the smash button, getting this far in the video, and if you're still watching, I know your dreams and aspirations will come true. I wish everyone to be truly blessed, and thank you from the bottom of my heart. Friends, be aggressive in learning, but be safe in investing. Give me a powerful fist bump.
No one ever sees me.